Hello, today is Monday, January 27th, 2025. I'm Tony Mangino from TC2, and this is Staying Connected. On today's podcast, we'll be discussing the recent increase in AT&T's Property Tax Allotment Surcharge, or PTA, and more broadly, how surcharges increase the bottom line costs of your ICT services. Joining me today is Deb Bowling from LB3. Deb advises Fortune 500 companies on their ICT transactions and knows a thing or two about the impact of surcharges. Deb, welcome back to Staying Connected.
Thanks, Tony. It's great to be back.
So, Deb, tell us about AT&T's announcement that there's an increase in the PTA surcharge.
If by announcement you mean posted deep in the bowels of the AT&T service guide, then yes, AT&T has announced an increase in the PTA. Jokes aside, AT&T has increased the PTA service charge from 4.55% to 5.6%, effective January 1st, 2025. So Happy New Year! To be fair, this increase brings AT&T into closer alignment with both Verizon and Lumen, who also have PTA surcharges right around 5.5%. All suppliers have, to varying degrees, surcharges that apply to the various services and service components of their primary enterprise networking products.
Deb, and these surcharges are mandated by the FCC or some state or local regulator?
Well, no. The suppliers prefer to shift the blame for these additive costs onto regulators. It's USF. The fact is that while these charges are standard fare across the industry, they are not required by the FCC or local entities in the strictest sense. They are typically levied to shift some of the cost of doing business onto the customer. PTA is a perfect example. AT&T says that the charge is, quote, is not a tax, but recovery of an expense that AT&T is required to pay, close quote. The sleight of hand here is that yes, AT&T is required to pay its state and local property taxes, but they are not required to pass those costs or any portion of them onto the customer.
Yeah, well, then in the case of AT&T, there's also the administrative expense fee they assess for processing USF payments, and the federal regulatory fee, which is a staggering 13.99%. And all of that applied on top of the actual USF fee, which for Q1 25 is 36.3%. And that's up from 35.8% in the last quarter of 24. Now, the other suppliers have similarly styled charges with slick names like the carrier cost recovery charge and the carrier annual regulatory charge and the cost recovery fee and on and on and on. Now, if your head's not spinning enough, I'll add that these surcharge regimes are not consistent across the suppliers, and they change even within the same supplier based on the type of service.
Tony, exactly. And these charges typically reside in online service guides where they can be increased at the discretion of the suppliers. You made an important point about surcharges differing based on the type of service. Can you expand on that?
Sure. So take AT&T, for example. I feel like we're picking on AT&T today, but their AVPN MPLS service, they charge USF and all the surcharges that come along with it on the dedicated access component of that service in the US. While for their dedicated internet service, what they call ADI, they charge a flat per port charge of $13.99 in lieu of USF and such on the access component. Verizon, for their part, charges USF and associated surcharges on dedicated access in the US, regardless of the service, whether it's MPLS or DIA. I guess the question becomes, what can an enterprise customer do to address these charges in their supplier agreements?
Tony, great question. From a contractual perspective, competition is critical to success. You may seek to eliminate the online service guide and have all costs, including the application and surcharges, fixed or capped in the agreement. This eliminates the risk of increases in existing surcharges or new ones, but the approach will be strongly resisted. A well-drafted material adverse change clause also helps. The material adverse change clause is most effective when the supplier must notify you of increases in costs, including USF and surcharges, and material changes to other online terms. Going full circle, if you don't succeed in having all cost and applicable terms fixed in your contract, including a snapshot of the online terms reviewed during negotiations, against which to measure adverse changes is a best practice.
And Deb, I'll add to that, from a financial perspective, knowledge is power. Customers need to understand the total cost of ownership of their networks. When building the business case for a technology migration, the shift from legacy MPLS to Internet First is a great example. Customers must be able to calculate the total cost of the proposed solution, accounting for these surcharges, and be savvy enough to accurately quantify the differences in the supplier's proposed solutions. Now, the reality is that in most cases, the account teams aren't even clear on what applies to what, where, and they certainly don't broadcast these additive and material costs in their proposals unless they're forced to do so. This is a key input in the financial analysis of supplier proposals that we conduct in our client engagements here at TC2. So, Deb, any final thoughts on the subject?
Well, Tony, I don't want to pick on suppliers, but the suppliers can be sneaky even when their account teams aren't aware of it. So ask key questions in a competitive RFP and review the applicable online terms. Use this knowledge and competition for power to negotiate market-leading financial and contractual terms.
Thanks, Deb, for your time today. To our listeners, if you'd like to learn more about how to quantify the impact of these surcharges on your total cost of solution ownership and to discuss strategies for addressing these charges in your supplier agreements, or if you'd simply like to discuss other ICT needs with Deb or me or any of our LB3 and TC2 colleagues, please don't hesitate to give us a call or shoot us an email. Finally, you can always stay current by subscribing to Staying Connected, by checking out our websites, and by following us on LinkedIn.